Well, we are almost through earnings season, and Hugh Johnson, Chief Investment Officer of Hugh Johnson Advisors, joins us now with a look at the markets and what is ahead for the next earnings season. Hugh, great to have you with us. Before we get, though, to the subject of earnings, I mean, what you're seeing right now are the markets being roiled by what is going on in the Middle East. Do you think it's going to get even worse?
Yeah, well, it's hard to tell whether things are going to get worse. It's hard to imagine that they're going to get much worse in Libya. But the markets are sending us a message. When you take a look at the price of oil, obviously, and you take a look at energy stocks last week, up 3.7%, which is a big move up in energy. The message is that oil prices are going to go higher, which really suggests that maybe we're headed towards some serious interruption in the flow of oil from the Middle East. You know, as mentioned before on your program, that Libya is really a factor because they are a member of OPEC, and they do account for 2.1% of the global production, and that's pretty meaningful. So right now, you're talking about possible interruption of oil flows, possibly higher oil prices, and that will have an impact on the economy.
And yet, Hugh, as I understand it, you've actually increased your outlook for the markets, though, right? You've raised your forecast.
Yeah, my forecast for both the markets as well as the economy up just a little bit, 3.2% roughly. Growth in GDP for 2011, 3.3% in 2012. My expectation for the stock market is pretty positive. It's positive, but not as positive as it turned out to be in 2010. So I think, yes, we're going to have positive news or a positive market environment for 2011 and 2012. If you get through it all, we're up about, I think, somewhere in the neighborhood of 14 or 15% from now until the end of 2012, which is a pretty healthy equity market environment.
Hugh, this is John Erlichman. Retail stocks have had this huge run over the last year. This morning we learned that Walmart's results are lower than what Wall Street expected, but Home Depot comes out with numbers that the street likes, and the stock moves higher. So how is an investor, especially in stocks tied to the consumer, supposed to make sense of those two differing stories?
Well, for one, they're very different companies, and the one important point is Walmart is not so much a consumer cyclical stock now. It's a consumer staple stock. They do a lot in the food, pharmaceutical business, so you have to categorize that as a sort of a stodgy, much safer company. On the other hand, you get over to Home Depot, that's very economically sensitive. That's properly a consumer discretionary or consumer cyclical. So I think you have to look at them separately. Walmart you buy when the stock market looks like it's turning down or investors are starting to play it safe.
Right.
When things are right the way they are now in an economically sensitive, sort of a positive bull market environment, you buy a Home Depot.
Hugh, thank you.